You're not alone. But what if you could earn steady passive income by simply owning the right stocks? In this video, we're revealing the best dividend stocks that deliver reliable income and help you grow your wealth over time. Before we jump in, make sure to like, subscribe, and hit the notification bell so you never miss smart investing tips that make your money work for you. Let's get started right now. What makes a great dividend stock? Not all dividend-paying stocks are created equal, and choosing the right ones requires understanding key qualities that set the best dividend stocks apart. The top dividend stocks typically share three essential characteristics: sustainability, growth potential, and financial stability. Sustainability is crucial because it ensures the company can reliably pay dividends without jeopardizing its core operations. A sustainable dividend means the business generates enough free cash flow, the actual cash left after operating expenses and capital investments, to cover dividend payments consistently. One useful metric to assess sustainability is the payout ratio, which compares dividends paid to earnings. Generally, a payout ratio below 70% indicates the company retains enough profits for reinvestment in growth and to weather unexpected challenges, reducing the risk of dividend cuts. Growth potential is what separates good dividend stocks from truly great ones. Companies that regularly increase their dividends typically have strong underlying business fundamentals and confident management teams who believe future earnings will continue to grow. These dividend growth stocks often outperform high-yield stocks that offer large payouts but do not raise their dividends over time. The steady increase in dividends not only provides rising income, but also signals a company's long-term financial health. Financial stability rounds out the picture by reflecting a company's ability to withstand economic ups and downs. This includes maintaining a strong balance sheet with manageable debt levels and generating revenue from diversified sources rather than relying on a single product or market. Top dividend aristocrats to consider. Dividend aristocrats are a select group of companies within the S&P 500 that have consistently increased their dividends for at least 25 consecutive years. These companies are often seen as pillars of stability and reliability in the stock market, making them attractive choices for income-focused investors. A prime example is Coca-Cola, which has raised its dividend for over 60 consecutive years. Despite shifts in consumer preferences and changing market conditions, Coca-Cola's vast global brand portfolio and extensive distribution network enable it to generate steady cash flows through economic ups and downs. This resilience allows the company to maintain a strong commitment to rewarding shareholders with increasing dividends year after year. In the healthcare sector, Johnson & Johnson stands out with more than 50 years of consecutive dividend increases. Johnson & Johnson's diversified business model spans pharmaceuticals, medical devices, and consumer health products, creating multiple robust revenue streams. This diversification, combined with a strong research and development pipeline and patent protections, gives the company sustainable competitive advantages that support reliable dividend growth, even in challenging economic environments. Procter & Gamble is another dividend aristocrat, known for its reliability in the consumer staples category. With a track record of over 60 years of dividend increases, P&G owns a wide array of essential household brands that consumers continue to buy regardless of economic conditions. Their ongoing focus on innovation, efficiency, and expanding presence in emerging markets drives long-term growth, which underpins their ability to provide consistent dividend payments to investors. Together, these companies illustrate the strength and appeal of dividend aristocrats as dependable sources of passive income through dividends, combining longevity, diverse revenue streams, and resilient business models. High-yield dividend champions. Real estate investment trusts offer some of the highest dividend yields in the market. Realty Income Corporation, known as the Monthly Dividend Company, has paid over 600 consecutive monthly dividends. Their diversified portfolio of retail, industrial, and office properties generates predictable rental income that supports a current yield above 4%. Utilities provide essential services that generate stable cash flows perfect for dividend investing. NextEra Energy combines traditional utility operations with renewable energy leadership, creating a unique growth story within the traditionally slow-growing utility sector. Their 25-year dividend growth streak reflects the company's ability to balance current income with future investment opportunities. Telecommunications companies like Verizon offer attractive yields supported by recurring subscription revenues. While the industry faces competitive pressures, Verizon's network infrastructure investments and diversified service offerings provide defensive characteristics that support dividend sustainability. Dividend growth is high-yield strategy. Choosing between dividend growth and high-yield strategies depends on your investment timeline and income needs. Dividend growth stocks typically start with lower yields but increase payments over time, creating powerful compounding effects for long-term investors. A stock yielding 2% that grows dividends by 8% annually will double its yield in 9 years. High-yield strategies focus on current income generation, appealing to retirees or investors needing immediate cash flow. However, extremely high yields often signal underlying business problems or unsustainable payout ratios. A balanced approach combines both strategies, allocating portions of your portfolio to establish dividend growers and select high-yield opportunities. Consider reinvesting dividends during accumulation phases to maximize compounding benefits. Dividend reinvestment plans allow automatic stock purchases using dividend payments, often without transaction fees. This strategy transforms quarterly dividend payments into additional shares that generate more dividends, creating a snowball effect over decades. Risks and red flags to avoid. Dividend investing isn't without risks. Companies can cut or eliminate dividends during financial stress, causing both income loss and potential share price declines. Monitor payout ratios, free cash flow trends, and debt levels to identify potential warning signs before dividend cuts occur. Sector concentration poses another risk. Many dividend-focused portfolios overweight utilities, consumer staples, and REITs, while underweighting growth sectors like technology. This concentration can limit long-term returns and expose investors to sector-specific risks. Maintain diversification across industries and company sizes. Yield chasing represents a common mistake, where investors focus solely on dividend yield without considering business fundamentals. Extremely high yields often indicate market skepticism about dividend sustainability. Research the underlying business, competitive position, and management quality before making investment decisions based primarily on yield. All right, that's a wrap on the best dividend stocks for steady passive income. Remember, smart investing and patience can build a powerful income stream over time. If you found this useful, give it a thumbs up and share your favorite stocks or questions in the comments below. And for more investing insights, don't forget to subscribe and hit the bell. Catch you in the next one.